Hey everyone, this is JP and I'm joined by my business partner, Matt. Thank you for joining the Rise Blue Ridge investor presentation. We are partnering with Rise 48 and we're very excited about this new investment opportunity. This specific asset is a 247 unit apartment complex in Charlotte, North Carolina. Now, I'd like to talk about, before we get into it too much, really why we love this deal and why we're partnering with Rise 48. And it's a couple reasons. You know, Matt and I always talk about stacking the deck in your favor. And what I mean by that is, you know, all investing has risk involved with it. But if you can stack the odds in your favor, stack the deck in your favor, you're doing your best to get rid of risk. And how do we do that? Well, let's invest in places that have high population growth, high rent growth, strong job growth. They're landlord-friendly states, and they're business friendly. I mean, you can't get any more stack the odds in your favor. You know, the opposite of that would be investing in places where the population is shrinking, right? Or rent growth is going down, or job growth. If there's no job growth, people aren't going to live there. They're going to move somewhere else. What that does is it hurts your renter market, right? The pool of available people that want to rent your apartment. So by investing in a place like Charlotte, North Carolina, they're to use Matt's phrase here, they check all the boxes. Also, you know, the team at Rise 48, they can renovate all the units to what's called a platinum level scope that will help drive successful investor returns. The interest rate that's being purchased at for this asset is extremely favorable given the interest rates and the market conditions today. And this part I'm really excited about is the fact that they're buying it at a 27% discount. A lot of people ask questions, hey, is this the right time to buy real estate? Matt and I know are in full agreement that absolutely, because of where the interest rates are, there's a lot of distressed sellers. And this is a prime example of being able to buy and take advantage of a situation or a market where you've got a distressed seller and they have to unload the asset, and the team is buying it as a 27% discount, which is phenomenal. And then, of course, you know, most importantly here is the team itself. There's a local team that's and they're vertically integrated. So the in-house property management, construction management, they're all able to control the execution of the business plan. And that's really where most of the risk is. And we know the guys at Rise 48 were able to do a great job. This is the disclaimer side. This is a 506B offering, so all of the investors have to have a pre-existing relationship with us. The deal is not available to the public. The agenda slide. The agenda for this presentation is we'll talk about us, the background, the sponsorship team, the fund offering, and then we'll pass it over to Rise 48's CEO and co-founder, Zach Happenstall, to talk about the asset itself, Rise Blue Ridge. Zach will go over the Charlotte MSA as well as this strong submarket. We'll also walk through the financial analysis, and then we'll go over the acquisition timeline, some of the key deadlines to be aware of, and then Zach will wrap it up with a Q&A session at the very, very end. On the sponsorship team side, it's comprised of the leadership team at Rise 48, which is Bikram Sandhu, the CFO, Robert Chiefchick, the Chief Construction Officer, and then Zach Happenstall is the CEO. And then on the Significant side, you've got myself, JP Albano, co-founder and CEO of Significant Lifestyle Communities. And I'm joined by my partner, Matt Shields, who is our COO and also co-founder. Matt handles all of our operations side. We're also an operator like Rise 48. So we have our own in-house property management that Matt runs and our own assets that we run on the day-to-day. That's why you don't see Matt very much, but you see me all the time. All right, well, let's jump into the offering summary. So we're aggregating capital and deploying it into this deal on your behalf to get preferential economics. In other words, because we're joining forces to put capital together in this deal, we're able to negotiate better terms than our investors would be able to do by themselves by coming in as a group. So you see here on the right-hand side is the org chart. We don't go into full detail on this webinar, but you'll have full access to this in the PDF business plan that's available on our investor platform. So by investing in this deal, it's a $25,000 minimum investment. You'll have an 8.1% preferred cash-on-cash return, which accrues. It's a 100 to 0 split between the passive investor and the sponsor until your preferred return is caught up. So 100% of the cash flow, 100% of the equity goes to you as the passive investor. We as the sponsor receive zero cash flow, zero equity until you've received 100% of your initial investment back. Plus that you receive that 8.1% per year before the sponsor makes any compensation through cash flow, our quote unquote sweat equity, if you will. So here you see the projected returns by investing in this opportunity. This is a very conservative risk-adjusted 5-year projection. We're projecting a 2.02 equity multiple over the course of 5 years. So for example, for easy math, if you were to invest $25,000, we are saying we would give you $25,000 back plus $25,000 of profit over the 5 years. 5% average cash flow per year over the 5 years, 20.3% average annual return per year over the 5 years, and then a 15.9% internal rate of return, or IRR, over those 5 years. So on the fund offering summary here, what you see is, start over again. Here you see that your annual cash flows look like by investing in this deal. As an investor, you have a preferred return of 8.1%. But these are, start over again. Here you see what your annual cash flows look like by investing in this deal. As an investor, you have a preferred return of 8.1%, but these are value add deals. They don't even start out at 8.1% in year one because they're value add deals where the team is busy renovating units, turning the units over, and increasing the rent. It just takes time. But you can see it starts out at 3.7 in year one, and then it will trend up each year. So whatever the delta is between the 8.1% and what you're receiving each year, that delta is accruing. And you'll be fully caught up on that upon the sale of the asset. Now I'll pass it over to Rise 48's CEO, Zach Happenstall, who will go over the background of Rise 48.
And so here you can see that we have a fully vertically integrated company. We have our own property management company and our own construction company. So we have 3 different companies here, which is the investment company, the property management company, and construction. We have over 250 plus full-time W-2 employees on full healthcare benefits. We have full control over all of the operations and the on-site management, and we simply rinse and repeat the same business plan over and over. So we just stick to our box. We're very vanilla. This is the only thing that we do. All right, here you see that we have built out true infrastructure in the Charlotte market. We wanted to make sure that we were laying down the foundation for operations before we entered the market. So we've already opened up a new office in the Charlotte area, in the South Park area. We've already hired local staff, and we also have full-time existing Rise 48 employees who are permanently relocating to Charlotte. We'll show you that on an upcoming slide here. And so we've got local trusted staff that have worked with us for at least 1 to 2 years each that are going to be working in this market. We have local staff that we've hired that already lived there. We have the exact same supply chain that we have in Dallas and Phoenix. So our supplier has a local warehouse, so same materials, same cost. And so we really feel like we're going to hit the ground running with our local infrastructure. Here you can see we have trusted Rise 48 employees who have all worked with us in Phoenix for at least 1 to 2 years, who are permanently relocating to the Charlotte, North Carolina market. All of them actually volunteered to do this. We did not ask them to do this. They actually got excited when they heard about it. Some of them already have family in Charlotte. Some of them just wanted, kind of a new city to live in and always wanted to be in that area of the country. And so we have Christian Cyrus, our operations manager. He'll be overseeing the operations for this asset. He's been really solid for us, overseeing several different properties in the Phoenix market. Amy Moore is our senior HR generalist. So she's been with us a couple of years now, and she'll be overseeing everything as far as HR and office management. She'll be at the office full-time, 40 hours a week. Justin Gandy is our regional maintenance director. He's overseen a large portfolio of assets for us in Phoenix and manages all the on-site maintenance staff, really trusted employee. We've got trusted pillars of our company that will be in this market, really hit the ground running. And here you can see our Charlotte deal statistics. And so since we started looking at deals in the Charlotte market in the beginning of February of 2024, we've now underwritten 39 different assets. Okay, so 39 different assets that brokers have sent us. And this is only the second deal that has actually worked in our model. And honestly, the reason this one worked is because the seller is distressed with their loan. They need to sell the deal to get out of this asset. And so you can kind of see here, it's only been a 5% hit rate on deals that we've looked at. So these deals are truly a needle in a haystack. And you can see across these 39 assets, our maximum price that we can get to on average is 30% lower than what sellers are looking for. Okay, so this is how difficult this is to find these deals. I mean, we spend several hours underwriting each deal, looking at the demographics, median income, crime, doing insurance, property tax estimates, shopping the comps. And so these deals are very difficult to find. And we're really excited to have found this deal, Rise Blue Ridge. And here you can kind of see this graphic shows you that with the supplier, we have the exact same materials at the same exact cost, same logistics that we have in Dallas and Phoenix. So it's nothing new for us. We're buying the same exact type of assets, doing the same type of interior innovation scopes, the same cost. It's just a different market. And we'll go over why we like the Charlotte market here shortly. But for us, like I said, rinse and repeat. just kind of our vanilla type of model here. And so here you can see our track record. We've successfully purchased, executed the plan, and sold 11 different projects so far, 11 different investments. We've never done a capital call, don't plan on doing any. We've distributed over $119 million of cash back to investors so far. We do monthly investor reporting, so you get a full report every month. Monthly cash flow distributions, you get a direct deposit hit your bank account first week of each month. Here you can see these are the 11 deals that we've successfully executed the business plan and sold. And so in the light blue, the projected returns, this is what we were projecting before we bought the deal. Each one of these rows is a separate investment. So you can see at the bottom here, this is the average. We always do a 5-year projected hold period. So it's an average of 60-month projection. We're projecting a 1.9 equity multiple, which means if you invested 100K, we'll give you your 100K back plus 90K of profit, and then just over a 15% IRR. In reality, the dark blue, you see actual returns. Okay, so we show the actual returns for every investment. And at the bottom, you have the summary. On average, we held these properties for just under 18 months. We averaged a 2.11 equity multiple, which means we more than doubled the money. If you invested 100K, we gave you your 100K back plus 111K of profit, and then over a 70% IRR. So we've drastically exceeded our projected returns in the past. And granted, the market was strong, but we haven't seen any other group across the country that was buying deals before us or during the same time period that have these strong of returns. This is a combination of sourcing these deals at a good basis, executing the business plan, structuring the debt correctly, and then knowing when to sell the deal. Okay. And so, we never projected these returns. And I've been telling people for 2 years, hey, I'm not going to double your money in 18 months going forward with interest rates increasing. But we do think that we can hit and exceed our projected returns, and we feel very confident in that. Here you see a summary of our portfolio. So we've now purchased 52 different assets, over 10,000 units, over $2.2 billion worth of transactions. So we have a lot of experience in this space. This is all we do is existing value add deals. We don't do development. We don't do any other asset class. Here you can see what our loan to value looks like. LTV on average across the deals that we currently own. On average, our LTV is 67.9%. So we've always been a lower leverage group, which means that we have a healthy cash down payment in these deals. All right, here you see the market occupancy. We just wanted to show people kind of what our portfolio looks like, how it's performing versus the market. Okay, so this is both Phoenix and Dallas. And you can see that in Phoenix right now, we have over 5,600, almost 6,000 units total. We have almost 3,000 units in Dallas. Now, the overall market occupancy for the entire market, according to CoStar, 89% occupancy in both markets. At the end of April, our occupancy in Phoenix was 95%. Occupancy in Dallas was 94%. So you can see here that we are exceeding the market. And we've actually been doing renovations where a lot of people have not, which naturally leads to more vacancy. So you can kind of see that we're drastically exceeding the market in both Phoenix and Dallas. And then here you see market rent growth. Okay, so this is for 2023. And so the overall trailing 12 organic rent growth the last 12 months in Phoenix right now is negative 1.8% organic rent growth. Dallas, negative 1.3%. You can see here that our year-to-date rent growth in Phoenix has been over 11%. Okay, and in Dallas, 7.5%. This is because we're renovating units, forcing appreciation to increase the rents. So it just shows you that for occupancy and for rent growth, we are vastly outperforming both markets. Never have done a capital call. Don't plan to do any 2024, next year, or the foreseeable future. The reasons for this, we have low leverage loans, as we just talked about. We buy 3-year interest rate caps. We raise a lot of cash reserves, have a lot of liquidity up front. And then we can renovate units on schedule, on budget, and truly execute our business plan and force appreciation. Here you can see that we have very transparent reporting. So you're going to get monthly reporting if you invest with us, where we show you everything. You have full access to the full financial package, which is the mortgage statements, the bank statements, the general ledger, the balance sheet. And if you don't want to go into all that depth, we're going to give you a very tidy 10-page executive summary, which hits all the key metrics, before and after photos every single month, so that you have that transparent reporting. Okay, let's talk about this opportunity. So like we said, this property is currently called W Flats Apartments. We're going to rebrand it to Rise Blue Ridge Apartments. It's a B+ property, a B+ location, 247 units, built in 1986. We're buying the deal at a massive discount, 20% plus discount from where it would have sold for just 18 to 24 months ago. The seller has to sell the deal by the end of June. So we're buying it at $141,000 a unit, $11 million less than what it was under contract for in 2022. And there's a ton of upside here. Okay, we're going to renovate 99% of the units. So basically all the units except for 2 of the units that they renovated fully. So 245 units we're going to take to our renovated scope here. Here you can see what the units look like right now. Okay, so you've got classic units with old flooring, old countertops, old cabinets, old appliances. We're going to tear these down, and you can see what our platinum scope looks like, where we do quartz countertops, stainless steel appliances, subway tile backsplash, brand new cabinets. And so we've renovated over 3,000 units since we've started to this level of scope. So we're very experienced. And again, we have the exact same supplier in the Charlotte market. Okay, so we're buying the exact same materials from the same source at the same costs. We've already executed this plan thousands of times. Here you see a summary of the offering. The asset is currently about 95% occupied. We're buying the deal for $35 million, which is about $141,000 a unit, raising just over $18 million of total equity, 2 to 5 year investment period. Let's talk about the area. So it's a great area, B plus location. You have the Wells Fargo East Coast headquarters, 7 miles from the asset, over 27,000 employees. You have Novant Matthews Hospital, 5 miles away, 1,400 employees. Bank of America has their national headquarters just 7 miles away in Uptown Charlotte, 16,000 plus employees. Then you've got Duke Energy, their national headquarters, over 37,000 employees, just 8 miles away. So you've got major national, international employers just miles away from the asset. As we talked about, there's a great value add opportunity here. We can renovate 99% of these units. Okay, and so 31% of the units have not been touched whatsoever. And we're going to take them to our full platinum level scope, okay, which we just showed you on that photo. 68% of the units, they've done a light renovation. We're going to take them to a higher level scope. We're going to put stainless steel appliances, new flooring, new baseboard, and two-tone paint. So we're going to renovate 99% of these units, and we're going to have 2 different scopes here, depending on what has already kind of been touched. But we're going to be pushing rents on 99% of these units. Here you see some facts about the Charlotte market. Charlotte ranked number 5 in the country for population growth, according to the most recent U.S. Census Bureau. Charlotte is now the 15th most populous city in the entire country. So Charlotte is booming. One of the reasons we wanted to enter North Carolina, specifically Charlotte, is because it's tops in the country for population growth, for job growth, rental growth, diversified employment. You can kind of see here the median sales price of a single family home in Charlotte is now $461,000. The reality is most people cannot afford to buy a home. They don't have the cash for that. They won't meet the debt to income ratio. And so they're going to want to rent nice apartments that are affordable. And that's what we're providing here. We're kind of catering to the masses. This is why this is such a strong investment, such a great market. Here you see our rental growth projections. We like to be very transparent with our projections for organic rent growth. So you can see here that we subscribe to CoStar, which is one of the leading multifamily analytic data companies. Okay, so we pay them for their data, and they are projecting in the next 12 months there to be 1.3% organic rent growth in Charlotte. We're projecting 0%. Okay, so we're actually more conservative than what CoStar is projecting for the next 12 months. They're projecting the next 5 years, 2.6 organic rent growth year over year, the next 5 years. We're matching them. So we're projecting just 2.6% organic rent growth. So this is very conservative organic rent growth assumptions here. You know, we're in line or below what CoStar is already projecting. Okay, let's talk about the asset itself, Rise Blue Ridge. We're buying it for $35 million, great basis, 9 total buildings, 247 units. These are large, it's majority 1 bedrooms. It's a large unit. So the average unit is 724 square feet, large floor plans, 1986 vintage, individual air conditioners, wood frame and brick construction, pitch shingle roofs, individually metered for electric. So it has all the characteristics that we look for in these 1980s value add deals. Here you see a summary of what those floor plans look like. So they're large, spacious floor plans. Again, you have some photos of what the interiors look like. We're going to tear this down and take it to that higher level scope that we always renovate to. Here you see some photos of the exterior. So this is a beautiful asset, you know, really solid brick and wood frame construction deal. These are the type of deals that we're trying to look for, well located, quality real estate. Here you see a breakdown of the unit mix. Like we mentioned, majority 1 bedrooms. You do have a good amount, 56 2 bedrooms. One thing I want to point out here, these are not aggressive rental increases. We're only assuming that we're going to be increasing rents by an average of $152 per unit. And that is proven out in the market comp. So like we'll show you here shortly that we've personally secret shopped all the comparable properties. So it's not like we're increasing rents by $500. We're only increasing rents by $152. And that's that's after we renovated to a very high level scope. These rents are already proven out. And so as part of our rental comp process, and we've done this, we've had our staff personally secret shop the comps in the Charlotte market, is that we look at properties that are in typically like a 5 to 6 mile radius that are similar size, similar vintage, and most importantly, looking at properties that have been renovated. We want to see what are renovated units achieving right now in this immediate area. So then we create our projected rents, we're right in line or below what's already being achieved, okay? And so here you can see that rental comp study. So at the top here, you have W Flats, which is Rise Blue Ridge, our subject property, and we've shopped 5 assets within a 6 mile radius that are all similar vintage, similar size, and have renovated units. You've got 1 bedrooms and 2 bedrooms here. This red horizontal bar, this is the average rent that's being achieved right now among all the comps, okay? These different blue bars, these are the different floor plans that we have at our property, Rise Blue Ridge. So these are the 1 bedrooms. You have 4 different 1 bedroom floor plans and 3 different 2 bedroom floor plans. As you can see, for every single floor plan, there's 7 total floor plans that cost 1 bedroom, 2 bedrooms. The blue boxes are our projected rents that we're projecting to hit after we buy the property, renovate the units, and increase the rent. So we're basically saying that after we renovate, we're going to be right in line or below what's already being achieved right now. We're not trying to reinvent the wheel here or have very aggressive rents. We're saying, okay, these properties nearby are achieving these rents right now. After we buy the property and renovate the units, we're going to push the rents up to these levels. This is why this is such a good investment opportunity, is because the rents are well below market. And these deals are really hard to find, okay? It's typically like a 2% hit rate when we're looking at deals that have this delta where we can renovate, push the rents up, and the rents are already proven in that immediate area. And so we've renovated over 3,000 units since we've started, and we've exceeded those rents on average by over $40. Okay, we're always hitting our rents, and I'll show you that on a separate slide. But this just kind of shows you the line of thinking. These are not aggressive rental increases whatsoever. Let's talk about the sales comps. We mentioned how it's such a good basis. So like I told you guys, this property was under contract in 2022 for $192,000 a unit, which was $47 million. We are buying it for $141,000 a unit, which is $35 million, $11 million discount, 20% plus discount. Here you see other properties that are similar vintage, similar size that have been trading recently for an average of $191,000 a unit. We're buying this deal for $141,000 a unit. So we're getting a major discount here, a great basis on this opportunity. Let's talk about the Charlotte market a little bit more, okay? And so here you can see these different maps. So in the middle, you have the Phoenix market, you've got the Dallas market, and then on the right-hand side, we have the Charlotte market. That yellow dot is our local office in South Park, which is a great location of Charlotte. It's literally 10, 15 minutes away from our 2 assets. So Matthews Point is down here, and then this red dot is our target property, Rise Blue Ridge. And so you can kind of see here that we've taken some data, and you can kind of see that going forward, occupancy and rental growth are supposed to start to stay strong and start to improve as far as rental growth goes in this market. And so a lot of the new supply has started to get absorbed this year and next year in these markets. And so, really excited about this Charlotte market. Here you see some nearby employers. You got Bank of America, Wells Fargo, Coca-Cola Consolidated, which is the largest Coca-Cola bottler in the United States, is nearby. Duke, Lowe's has their HQ. There's a ton of huge companies that have their headquarters in Charlotte, like literally within 10, 15 minutes of this asset. So great employers. You can see Toyota, Fujifilm, VinFast. All these companies are investing billions of dollars into this Charlotte, North Carolina market. And they've obviously done their research and development. So you want to follow these big companies. Here you see an employment profile, U.S. Bureau of Labor Statistics. This just shows you that Charlotte has very diversified employment. We always look at these statistics for every market to make sure that they're not too heavily concentrated in any one industry. Okay, so you can kind of see here that You've got trade, transportation, utilities, which is multiple industries, makes up just 20% of the workforce. You have other industries making up these categories. Mining, logging, and construction makes up only 5.7%. That's a good sign. You don't want to be in a market that is heavily concentrated in construction jobs, because those jobs can dry up when there's an economic downturn. Okay, investment highlights. And so we talked about the interiors. We're also going to completely rebrand the asset with new 3-tone exterior paint, a new permanent monument sign with an LED backlight, just helps the curb appeal, leasing activity, new banners. We're going to upgrade the landscaping. We're going to upgrade the pool area with new sail shades, furniture, restore the pool deck. We're going to upgrade the leasing office and the clubhouse. And then, as we mentioned, we're going to renovate 99% of those interiors to different levels of scope to really upgrade them and push those rents. Here again, you see what a classic unit looks like on the top, and then you have what our renovated unit looks like on the bottom here. Here you see a CapEx budget, and so you can kind of see here that for these units, the 77 units that we're taking from just pure classic up to our full upgrade, we're budgeting $16,500, and then those units that they've already partially renovated and we're going to take them to a higher level, we're going to spend $6,000. We budgeted $1,500 to put in sub-metering for the units so that we can basically bill back the utility costs to the tenants, which will help generate other income revenue for the property. So we've budgeted that in there as well. And all of these numbers, by the way, have been completely dialed in from our due diligence. So our staff, we flew about 10 people out to Charlotte for this initial due diligence, and our staff walked every single unit. We did multiple inspections on roofing, plumbing. We had electricians out there. All these numbers are fully dialed in. We have our same exterior painting company that does all of our assets in Phoenix and Dallas. They're doing our exterior paint in Charlotte. Okay, so our guy Dino is flying out to Charlotte to do that. So these numbers are all dialed in. And again, we have the same supplier, the same supply chain, same cost. So we know that these numbers will come in where we budgeted it. So you can kind of see here that we're budgeting about $835K for exterior renovations. We have about nearly $1.7 million in contingencies that we've built in. Construction management fee you see here is 7.5%. Just to be very clear, investors do not pay this fee. The lender is paying the construction management fee as part of the loan proceeds. All of these CapEx dollars are going to be financed by the lender only if we use them. Okay, we're not raising this money from investors. And so because we buy all the materials directly wholesale from an overseas manufacturer, and we front the cost on that, and we do all the construction management with our staff, the lender pays us this construction management fee to help us cover our overhead. Okay, if we were using third party, then this would go to a third party company. So if you go through the entire CapEx budget, you're at about $5.5 million. I mean, we've never gone through the entire CapEx budget. Okay, let's go to the debt financing slide. This is probably the most important slide of the entire presentation, probably the most relevant slide. And so you can kind of see this is a very low leverage loan. We're at about 67.8% loan to value. So we're going to have about a 32% cash down payment. Okay, so we're going to have a lot of cash in this deal, very low leverage, very conservative approach. You can see here future funding. Again, these are the CapEx dollars. This is not funded up front. Okay, this is if we use these dollars. So how it works, we're going to buy the property and we have to front the cash at the property level to buy materials, pay vendors, complete the work, then submit a draw to the lender, and then they'll reimburse us for what we've spent. Okay, so it's all called future funding. They're only going to reimburse us for what we spend. This is a 3+1+1 term. So it's a 3-year term with 2 1-year extensions that we can extend to year 4 or year 5. The entire term is interest only payments. So we don't have to pay anything on the principal, which really helps with cash flow. And this is what's called a floating interest rate loan. Okay. And some of you guys are probably thinking, wait a second, why would you do a floating interest rate loan when there's been so much volatility the last 24 months with interest rates going up? What are you thinking there? And so we'll tell you, why we do it, but we'll also talk about how do we mitigate against the risk of the floating interest rate. And, we can tell you guys that we have experienced all different types of loan products since we've been doing this. We've purchased deals with 10-year Freddie Mac fixed rate loans, 10-year Freddie Mac floating rate, and we've done these debt fund floating rate loans. So we know the pros and the cons of these different products upon acquisition, through operations, and then upon sale. Okay. And I can tell you, most people don't realize is that when you get a fixed rate loan, whether it's Freddie Mac, Fannie Mae, a bank, whomever, there's a price to pay, okay? Because whenever a lender gives you a fixed rate loan, they have a lot of risk on their end because they're guaranteeing that your interest rate will not change. And if interest rates go up like they have in the market, then they have to cover that. Okay. So the way that these lenders cover themselves with a fixed rate loan is they hit you with a really nasty prepay penalty called yield maintenance or defeasance. Okay. So basically what that means is that if it's a 10-year loan, fixed rate, and you want to sell after year 2, you have to pay the lender the entire yield they would have made for the next 8 years to get out of that loan. Okay, we learned this the hard way from experience. 2 of our very first deals, we put 10-year fixed rate debt on them because we said, why wouldn't you do fixed rate loans? It seems like a no-brainer. So in 2019, we bought a deal in Phoenix. We bought it for $17 million. We were acing our business plan, renovated over 50% of the units, drastically exceeding our projected rents. 2 years later in 2020, we want to go sell that deal. And so we tell the lender, hey, we're going to sell the deal. And they say, okay, you have a yield maintenance prepay penalty of $3 million of cash right off the top. So $3 million out of investors' pockets. And we did the calculations. We're like, oh no, we have to hold this deal and keep renovating to increase the value. So we held it for 8 months longer, kept renovating, increased the value even more so that we could sell the deal, absorb the massive prepay penalty, and still net out investors over a 2x return. We were lucky the market was strong, frankly. Otherwise, it wouldn't have been possible. So people that are putting fixed rate debt on loans right now on deals, they're fixing their debt at the peak of the market. And when interest rates come down, yield maintenance prepay penalty goes up. Okay, there's an inverse relationship, and you cannot underwrite yield maintenance prepay penalty. It's impossible because you don't know when you're going to sell and it changes daily. So the reason we don't do fixed rate debt is because you get hit with a nasty prepay penalty and you could ace your value add plan, and that prepay penalty will wipe out all the value, makes it difficult for you to sell, makes it difficult for you to refi. So the reason we do floating rate debt, all of that to say, because if you see right here, we have no prepayment penalty so that we can sell or refinance at any point and truly maximize the returns to the investors and maximize our flexibility. Okay. The way that we mitigate against the floating interest rate is that we buy a low interest rate cap. So we're buying a cap up front where my max interest rate is 4.75% day one for the first 3 years. This is a 3-year interest rate cap. So we're effectively engineering a 3-year fixed rate loan where I have significant positive cash flow day one and making sure the deal works in that way. And some of you guys may be thinking, well, okay, what happens after year 3 when your cap expires? So we have a lot of options, a lot of flexibility, when that happens. You can kind of see here below, we've underwritten the deal so that by the end of year 3, we've made sure that the net operating income and the debt service coverage ratio, the DSCR, are high enough so that even if interest rates have not come down from where they are right now, we can qualify to refinance into a new loan by the end of year 3. Okay, so by the end of year 3, we will be able to refinance even if interest rates have not come down from where they are right now. That's option 1. Option 2 is if for some reason we can't refi, we don't want to, we can extend the term of our loan to year 4 or year 5, and we have significant cash reserves that we're raising up front to buy a new interest rate cap to extend us to year 4 or year 5. That's the second option, is to extend, buy a new cap. Third option is that we could sell the deal before the end of year 3, which we're not counting on that or banking on that in the model. But honestly, we would not be surprised if interest rates drop in the next 36 months. We increase the value by renovating units and we could sell the deal early. And that's what we will plan to do if we can. So we have structured the debt to truly give us the maximum flexibility. This is from years of experience from buying over 10,000 units and knowing the pros and the cons of different debt strategies. So that's kind of how the debt is structured here, and to give you guys an explanation. Here you see an interest rate fluctuation. So typically in the past, we've given people a sensitivity that shows with different interest rates what your projected return looks like. Well, we are maxed out at a 4.75% interest rate day one, and those are the projected returns that we're showing you day one. Okay, and so we're not assuming that rates will come down below that. If rates do cut the next few years below 4.75%, our rate will actually go down, which is actually beneficial to us. All right, let's go through some case studies of renovation. So I'll get through these kind of quickly. So this is Rise Highland Meadows. We bought this deal beginning of 2023, our first Dallas deal, 328 units. We've renovated 108 units so far, average increase $428 per unit, $86 above our initial projections, okay? Dallas actually has negative organic rent growth the last 12 months, and we're still getting these massive increases. We increased NOI by almost 14%. We have a very healthy debt service coverage ratio of 1.69. So you can kind of see before and after photos, case study. And then you can kind of see some exteriors of Rise High Meadows. This is before on the left-hand side when we bought it. This is the after photo. So same exact paint scheme will be on this deal we're talking about today, Rise Blue Ridge, same type of monument sign. Everything will be the same. Desert Cove, we purchased this in March 2023 in Phoenix, 186 units. We renovated 42 units. Average increase is $299 per unit. That's $37 above our initial projections per unit. And in Phoenix, there was negative 4% organic rent growth in 2023, and we still drastically exceeded our rents. 6.3% NOI increase. You can see here that we've got a healthy debt service coverage ratio over 1.6 as well. Before photo on the top, after photo on the bottom here. And then here you see on the left-hand side the before photos of the exterior when we bought the deal last year. And here again, you see that same exterior paint scheme that we will do on Rise Blue Ridge. Then we quickly want to show you this. So we have now renovated over 3,000 units since we've started. Okay, on average, we've increased rents by $438 per unit across over 3,000 units, which increased NOI by over $16 million. If you take a 5% exit cap, then we've increased the value of assets by over $320 million. Okay, so you can see here that across 3,000 units, we've exceeded our rents on average by $44 per unit. So not only hit our projected rents, we've exceeded them by $44 a unit across 3,000 units the last several years. And this is even counting data. Most of this was in 2023. We made a big push to renovate to fight back against interest rates, and we were fighting against negative organic rent growth. We were still able to get these big pushes. And so you can kind of see here that if we were to exceed our pro forma rents by $44 a unit on Rise Blue Ridge, which we're not projecting, but if we did, we would add an additional $2.6 million of value on the back end, which we're not including in the underwriting. So this just shows you, the last, 3.5, 4 years, what the renovation data has really looked like, and that we've become very proficient just doing a very rinse and repeat assembly line type of process. We're doing the exact same business plan here in Charlotte. Here again, you see just last year, 2023 renovated over 1,900 units, average increase $453 a unit, $20 above our initial pro forma. All right, let's jump into the financial analysis, then we'll start wrapping up this presentation. So $35 million purchase price, raising just over $18 million of equity. You have a full sources and uses slide here on the right-hand side. I won't go through full on this on the presentation, but you have full access to your PDF business plan that goes through all of that. Here you see the 5-year pro forma. So this just shows you what the profit and loss statement looks like for the 5-year pro forma. I won't go through all of this on this presentation, but one thing I'll just point out is if you look at the total rent revenue, right here, year over year change, it shows you years 1 through 5. We're actually projecting negative 4.8% total rental revenue in year 1. Okay, and this is a conservative underwriting measure because we want to make sure that in year 1, we're going to be turning units over to renovate them, burning off loss to lease. So we're being very conservative, actually assuming negative rental revenue in year 1 as we execute the business plan. Then we're bleeding out that growth really over the first 3 years. In reality, we typically see a lot higher rental revenue in year 1, but we want to be conservative from an underwriting perspective. Okay, tax projections. So, property taxes are always very important, and we have a property tax consultant in the Charlotte, North Carolina area for Mecklenburg County, and property taxes are actually very friendly and easy to forecast in North Carolina. Okay, it's not like Texas where you have the horror stories. And so taxes are only reassessed by law every 4 years in North Carolina. They were just assessed last year. Okay, so we have a pretty good idea where they're going to be. Based on our tax consultant, we're projecting a 23% increase in 2027. They're not going to get assessed again until 2027. So if we sell the deal in 4 years or less, or 3.5 years or less, we don't have to deal with this. But based on our property tax consultant, they're not going to get reassessed till 2027. This is North Carolina law, and we've assumed a very large increase. They actually think that they might go down the next couple of years. And so you can kind of see that we've built that in there, and we're very conservative as far as property taxes. Here you see a break-even analysis. So this just shows you where the physical occupancy needs to be years 1 through 5 for the property to cover its own operating expenses and debt service. Okay, so this is a very conservative deal. You can see that in year one, we just need to be at 72% physical occupancy, and this property covers its own expenses, its own debt service without issue. The asset's currently 95% or 91% occupied. I'm sorry. And so we don't expect to get anywhere near 72%. Okay. And then you can see as we renovate the units, increase the revenue, that break even starts to decrease. Now, even on top of that, you can see that we are raising over $1.9 million of liquid cash reserves. They're not allocated to anything. That means that we could start out day one at 61% physical occupancy and stay there for 5 consecutive years at 61%. And we have enough reserves to never have to do a capital call because we could cover our expenses and our debt service. So this would be unthinkable. You'd have to almost do that on purpose to perform that poorly. But it just goes to show you that these are the reasons we never done a capital call. We don't plan to do any on this deal, and why we're really excited about this conservative underwriting.
Now we'll go over the key deadlines to be aware of if you want to participate in this opportunity. So basically the pieces that we need to be conserved on for the deal timeline is the following. We're announcing the deal on June 6th or June 7th. The deadline, we're giving everyone about a week to review this webinar, the materials. And then on the 18th is when we're opening the window to put in your soft commit. And we're opening up at the same time for everybody, right? So you've got that one day on the 18th at 12:15 Eastern time to put in your soft commit for the deal. First come, first serve basis. So if it fills up before you get to put in there, you won't be able to participate. You'll be added to a waiting list if the spot opens up, but it's unlikely that will happen. And then you've got 3 days to finish the paperwork to get the funding done and the paperwork done so that we can be on time on getting the cash over to Rise 48 so they can close escrow and acquire the property at the end of June. Now, they project that in August, they will begin the monthly reporting. And then in September is when they'll start making their monthly distributions. So we do fully expect this deal to fill up quickly, as this is a rare opportunity. So please make sure to fill out the soft commit form, save your spot, and be aware of these deadlines. Now I'll pass it back to Zach to go over a Q&A session of frequently asked questions that we get from investors.
Okay, let's do a Q&A session and we'll end the presentation. And so there's a few, typically or frequently asked questions that we get from investors. One is, when do monthly reporting and distribution start? We kind of just talked about that, but we're closing at the end of June. We need 1 full month of operations to begin reporting. And so the last week of August will be the first report to reflect July performance. Okay. After that first report, you'll get a report the last week of every single month to reflect the previous month's performance. We're going to start distributions beginning of September. After that first distribution, you'll get a direct deposit, hit your bank account first week of each month going forward. Another question that we get a lot is, are the distributions treated as return on capital or return of capital? The answer is that they are return on capital, which means that every monthly distribution you get is a profit on your initial investment. Okay, we are not drawing down your capital account. So every monthly distribution is a profit. Once we sell, we have to give you your initial investment back. Okay, so that's kind of how that works. A lot of investors want to ask, okay, are you going to do a cost segregation study on the deal? What are the depreciation benefits? The answer is yes. We'll do a full cost segregation study on this opportunity. And so we're going to upload a K1 into your portal in springtime or Q1 of 2025, which will reflect 2024 tax depreciation. Okay, the depreciation benefits for the 2024 tax year. So we'll upload that. Another question that we get is, are the sponsors going to invest their own capital in the deal? The answer is yes. We as a sponsorship group will invest at least $250 to $500K of our own personal cash in the deal. So we have significant skin in the game. Our interests are truly aligned with the investors. I can tell you that we have over 4,000 individual investors, and I am the largest single investor of my own cash out of any investor. Bikron is second, right there behind me. So nobody has more money in the portfolio than we do. We are also signing on the loan as guarantors, a lender. So we have to meet certain net worth liquidity requirements. They're background checking us for every single acquisition. We have to give them, quarterly personal financial statements, schedule of real estate owned every quarter throughout the investment. So, we have everything to lose. We're fully invested and are truly aligned with the investors. And so I think that pretty much wraps up all of the frequently asked questions we typically get. If you're interested, please make sure to fill out the soft commit, reach out to us with any questions, and we look forward to partnering with you. Thank you.